We have officially entered the event horizon. For years, warnings were issued that the silver market was fundamentally broken, that the suppression was artificial, and that when the dam finally gave way, the water would not gently flow, it would violently crash. Today, Saturday, December 27th, that dam did not merely crack, it completely disintegrated. The closing data from the electronic session tells the story clearly. Silver is trading at $79.25, up 7.34 in a single trading day, a move of 10.21%. Let this be absolutely clear. Commodities do not move 10% in one day under normal market conditions. A move of this magnitude is not a rally. It is a liquidation event. It is a crime scene. What we witnessed was the collapse of a major financial entity. Somewhere in the world, a massive short seller was destroyed, forced to buy back every contract at market price with no regard for cost. Charts, or logic, hammering the buy button until the account balance hit zero. Because this occurred during Ghost Week, the thinnest liquidity period of the year, there was no one left to sell to them. The price teleported. It went vertical. We are now standing at the doorstep of $80. In this emergency market update, we are dissecting the anatomy of a meltup. We are examining gold at $4,534 and why it proves the dollar is collapsing in real time. And we are preparing for Monday morning, because if silver closes the week near $79, the Sunday open could trigger a limit event that freezes the global exchange. The game has changed, the system is broken, and the panic is only beginning. To understand the violence of a 10% move, you must understand forced buying. In a normal market, buyers and sellers negotiate. In a liquidation, negotiation ceases entirely. The clearinghouse takes control of the bankrupt fund's computer, and the algorithm is given one command: close all positions immediately. It does not care whether silver is $75, $79, or $100. It simply buys and consumes the entire order book. The vertical line on today's chart represents the market impact of a whale dying. Massive volume, instant speed, confirmation that the short squeeze has moved from theory to systemic reality. The dominoes are falling. First retail shorts, then family offices, now institutional funds. Next will be the bullion banks themselves. A 10% move in silver is not just about a metal, it is the repricing of the global monetary system. Investors are losing faith in the currency used to price that metal and are demanding out at any price. Gold provides the context. Gold leads, and gold is trading at $4,534, up more than 1% on the day. Economists once called $4,500 impossible, a doomsday number. That doomsday has arrived. Gold holding above $4,500 validates silver's move. With a historical ratio near 15-1, silver should be near $300. At $79, silver remains mathematically cheap, lagging and attempting to catch up. Algorithms see gold at all-time highs, see silver still far below its inflation-adjusted peak, and deploy billions into silver as the last asset not fully repriced for inflation. Do not fear the vertical chart. It feels uncomfortable only because we are conditioned to suppression and slow grinding moves. Freedom is chaotic, and silver is breaking free. Now we must address weekend risk. It is Saturday. Markets are closed. The price is locked at $79.25, but the news cycle is accelerating. Headlines of bank insolvencies and hedge fund failures are beginning to surface, along with rumors of settlement failures in London. This creates immense psychological pressure for anyone holding paper claims. Those investors are questioning whether exchanges will even open on Sunday or whether brokers will survive Monday. Fear is forcing capital out of paper and into physical metal. Reports indicate online bullion dealers have pulled inventory entirely, sold out, site maintenance, call for pricing. These are unmistakable signs of physical market failure. The metal is moving faster than their systems can price it. On the street, silver is already trading near or above $100. The $79 spot price is irrelevant. When goods cannot be purchased at the official price, the currency has failed. We are witnessing a historic pivot. Paper promises lose all meaning when vaults are empty. Now consider the Sunday night limit up scenario. CME circuit breakers halt trading if prices rise too fast. With silver closing near $79.25, any meaningful gap higher could immediately trigger a halt. When that happens, panic ensues. Shorts desperate to cover are trapped in a locked market. When trading resumes, it gaps higher again. This is how locked limit-up markets persist for days, as seen in nickel and lumber. If you see a halt Sunday night, do not panic. It means demand has overwhelmed the exchange itself. However, once limits expand, volatility will be extreme. Silver could swing $10 in an hour. This is not a market for leverage. It is a market for ownership. The January effect now becomes critical. Funds that planned to buy in January are staring at $79.25 in disbelief. They missed $70, they missed $75. History shows they will chase. Institutions buy strength. A 10% day signals performance and attracts capital. January the 2nd could unleash a wall of money into a market already broken. This move is only the pre-shock. The earthquake comes when pension funds arrive. A push toward $100 by mid-January is now plausible. That said, volatility cuts both ways. A profit-taking flush back to $75 would be normal and healthy. In a vertical market, a $5 drop is a dip, not a reversal. Supply is gone. Any pullback is a gift. There's also black swan risk. A 10% move without a clear headline usually means the news has not yet broken. Someone knows something. A bank failure, geopolitical escalation, or export restriction may be imminent. The market senses it first. By the time headlines appear Monday, silver could already be $85. Price action is truth. News is merely the excuse. This weekend, stay calm. Secure your holdings. Audit storage. Exit unallocated accounts. Read ETF prospectuses. When markets reopen, chaos follows. We must now examine casualties. Futures are zero-sum. Billions made by longs mean billions lost by shorts. These are not retail traders. They are systemically important institutions. Rumors from London and Singapore suggest a major clearing member missed a margin call. This is a Lehman-style moment for commodities. If losses overwhelm default funds, contagion spreads. Other banks are forced to cover losses, liquidity evaporates, and credit freezes. That is why bond markets are shaking. Silver shorts are structural beams in the financial skyscraper, and one has snapped. If banks stop trusting each other, the Fed must intervene by printing money, which only drives silver higher. It is a perfect trap. Now consider the industrial response. CEOs at companies like Tesla and Samsung just watched silver jump 10%. Cost structures exploded, but availability is the real fear. Suppliers invoke force majeure clauses, cancel contracts, and push buyers into the spot market. Industrial users must compete directly with investors for physical supply. This is price inelastic demand. They pay whatever it takes. That is how a 10% day becomes a 20% day. Physical dealers confirm the stress. Call for price signals inventory scarcity, not abundance. The supply chain, from mine to mint to dealer, is grinding to a halt. Gold at $45.34 confirms everything. Gold up 1.2%, silver up over 10%. The system is broken, and silver is exposing it in real time. Silver is now outperforming gold by nearly 10 times. This is exactly the high beta behavior we warned about. When a precious metals bull market enters its manic phase, silver always takes the lead. It is a smaller market, far tighter and structurally more volatile. That is why it moves faster and harder. Right now, we are watching the gold-to-silver ratio implode in real time. At the start of the week, the ratio was above 60. With silver trading near $79.25, that ratio is collapsing into the 50s. Traders obsess over this metric. As it compresses, it attracts a specific class of momentum traders who specialize in ratio convergence. Their strategy is simple. Sell gold, buy silver. That rotation adds a fresh layer of demand. Capital flows out of the expensive metal and into the cheaper one, driving silver even higher. This reflexive loop continues until historical norms are restored, 30 to 1 or lower. At a 30 to 1 ratio, silver would trade near $150. Even after a 10% daily explosion, silver remains the value trade, with roughly 100% upside just to align with gold's current valuation. Now we need to address margin debt and trader psychology. Many retail traders look at a parabolic chart and think the move is over, that it is too late, and that shorting makes sense. That instinct is deadly. You do not short a parabolic move. Markets can stay irrational longer than traders can stay solvent. Shorting a monetary metal during a currency crisis is financial suicide. But what about buying at $79? That depends on how you buy. Buying physical metal means exchanging paper for money. Yes, that makes sense. Buying leveraged paper contracts does not. The volatility ahead will be brutal. We could see a $5 limit down day followed by a $10 limit up day within 48 hours. Anyone on margin will be destroyed in that swing. You can be directionally correct and still lose everything. This market rewards ownership, not leverage, cash only. Unlevered assets only. Attention now shifts to the Sunday night open in the US and Monday morning in Asia. The Shanghai Gold Exchange opens first. They will see the 10% New York move and must decide whether to take profits or chase. Given China's massive industrial demand and cultural affinity for momentum, panic buying is the more likely outcome. If Shanghai gaps silver to $85, New York will be forced to follow. This is how markets behave in crisis mode. We are no longer trading intraday ranges, we are trading gaps. The real price discovery is happening while markets are closed. Day sessions consolidate. Overnight sessions teleport. This is classic institutional accumulation. Large players buy at the open and the close. They do not scalp candles. Now consider the political reaction. If silver touches $100 next week, Washington will pay attention. Green energy costs explode, solar panels become more expensive, electric vehicles become less affordable. Inflation metrics worsen, Politicians will look for scapegoats. They will accuse speculators and hoarders. They may threaten investigations, price controls, or even invoke emergency powers to secure supply. Ironically, any political intervention only validates the shortage. Government involvement confirms that inventories are depleted, a single headline. White House monitoring silver volatility would likely push silver another 5 higher by signaling that official stockpiles are exhausted. Zooming out, the 10% move in silver is a warning shot from the bond market. Yields are under stress. The dollar is bleeding against real assets. We are watching the great rotation unfold, capital leaving the paper economy and flooding into tangible assets. This is not a short-term trade. It is a secular shift, the kind that lasts years. It happened in the 1970s. It happened in the 2000s. It is happening again, but with far higher debt levels and far tighter commodity supply. That means the squeeze will be more violent and the spike more extreme. We are now entering the vertical phase. In this phase, technical indicators lose relevance. Resistance levels do not matter. Overbought signals are meaningless. The only variable that matters is flow. Money is rushing in. Metal is disappearing. Until either of those changes, price continues higher. Look at the volume. Friday's volume was the highest of the year. That is confirmation. This was not a thin holiday meltup. This was a high-volume fight, and the buyers won decisively. Every sell order thrown by the banks was absorbed. The float has been cleared. Overhead supply is gone. The road to $80, $90, and $100 is paved with empty vaults. So what do you do this weekend? You prepare. Prepare for volatility. Prepare for media hysteria. Prepare mentally. You now hold a high-value asset. Do not advertise it. Do not brag. Security matters. You should also begin thinking about an eventual exit. Not today, not tomorrow, but later. At what point does euphoria become unsustainable? We are not there yet, but you must decide in advance. Will you swap silver for gold at 30 to 1? Will you exchange it for land or productive assets? Write it down. Make a commitment to yourself. Because when silver hits $200 and everyone is screaming to buy, discipline will be the only thing protecting your sanity. When we say it's over, we are talking about suppression. Suppression is finished. True price discovery has begun. The banks have lost control of the beach ball, and it is accelerating toward the surface with explosive force. This is financial history in the making. December 27th, 2025, the day silver broke free. We are living through the longest weekend in modern finance. The price is frozen at $79.25. Markets are closed, banks are closed, vaults are locked, but panic is wide open. Right now, in boardrooms across London, New York, and Hong Kong, emergency meetings are underway. Risk managers are staring at balance sheets shredded by a 10% gap and realizing they may not survive the Sunday Open. This is not just a trading event, it is a clearinghouse event. Futures markets are built on trust in the central counterparty. The trust is being tested. Margin requirements are exploding. Losses are cascading. If even one clearing member fails, contagion spreads, liquidity evaporates, confidence collapses. Rumors are already circulating that multiple mid-tier commodity firms are insolvent. If an exchange default is announced, silver will not simply rise, it will go no bid. No sellers at any price. That is the ultimate bullish signal for physical metal. When the paper casino burns down, the chips are worthless, but silver remains silver. At the same time, industry is acting decisively. Major manufacturers are bypassing public markets entirely, striking private supply deals directly with miners. They are offering $85 an ounce or more for guaranteed delivery, cutting COMEX in London out of the loop. This privatizes supply. Metal that once supported ETFs and futures is disappearing into private industrial chains, never to return. Official production numbers may look stable, but available supply is collapsing. That is why inventories are crashing. Now the public is waking up. Google searches for how to buy silver have surged. The average person does not buy value, they buy motion. A 10% day triggers fear of missing out. Retail orders are stacking up while markets are closed, queued for execution at the open. When those orders hit alongside institutional covering and industrial hoarding, with no sellers available, the result is explosive. We are 75 cents from $80, and $80 is psychological. Once broken, the narrative shifts from silver rally to silver mania. That shift pulls in speculative capital, algorithms, and leverage players, accelerating the move to $85, $90, $95. Understand the distinction. The shortage takes silver to 100. The mania takes it to 200. We are transitioning between those phases right now. The 10% candle was the starting gun. Industry is hoarding. The public is waking up. Supply is vanishing. And Asia opens first. In the final chapter of this emergency broadcast, we will outline exactly what to watch on the Sunday night open, explain the limit-up mechanics, and walk through how to manage your emotions during a vertical melt-up. The waiting is painful, but it is almost over. The markets are quiet, but this quiet is an illusion. It is the calm of a coiled spring packed with energy and ready to snap. In less than 36 hours, Asia will wake up. The electronic futures market, GlobeX, will turn back on, and the entire financial world will be staring at a single screen, silver. In this final breakdown, part 4, we are laying out the Sunday night battle plan. You will know exactly what to expect when trading resumes. You will understand the limit rules, so you do not panic if the market halts. And most importantly, you will have the psychological armor required to survive what may be the most volatile week the precious metals market has ever seen. The system has failed. Real price discovery has begun. Now we finish this. Let's think strategically. Put yourself in the position of a trader sitting in Shanghai or Tokyo. You just watched New York close the week up 10%. Western buyers are desperate for supply. London vaults are depleted. When your market opens Monday morning, do you sell into that strength? Of course not. You front-run New York. You buy everything available before American traders even wake up. That behavior creates a gap higher. Silver is very unlikely to reopen at $79.25. An $82 or even $85 opening price is entirely realistic. For traders sitting in cash, that gap is painful. The market is running away, forcing them to chase, and every chase order adds fuel to the fire. But for holders, for you, that gap is confirmation. It proves that Friday's close was artificial. The market is searching for a level where someone is finally willing to sell, and at $79, there are no sellers. Price must jump, $85, $90, higher still, until supply appears. Now we need to discuss exchange mechanics. The CME operates with circuit breakers, rules designed to slow markets moving too fast. Silver has daily price limits. If price rises a certain amount from the prior close, the exchange triggers a limit-up halt. Trading stops, screens freeze, no buying. No selling, the market locks. If we gap higher Sunday night, silver could hit limit up within minutes. What follows is pure psychological pressure. If you're short and the market is locked limit up, you're trapped. You cannot exit. You know that when trading resumes, price is likely to gap higher again. Losses are guaranteed to grow. That fear forces short sellers to line up market on open buy orders for the next session at any price. If you see a trading halted message Sunday night, do not panic. It does not signal a crash. It signals explosive upside. The market is moving faster than the system can process. It is one of the most bullish signals possible. Sit tight. And when the market unlocks, volatility will be extreme, but direction usually remains higher. Pay close attention to Monday's headlines. For years, financial media dismissed silver entirely. After a 10% day followed by a limit-up open, they won't be able to ignore it. But beware the narrative. They will call it a bubble. They will blame internet traders. They will bring out commentators claiming silver is overvalued. They are reading from an outdated script. They do not understand industrial demand. They do not understand China's stockpiling. They do not understand military supply constraints. Do not let the media shake you out. They are a contrary indicator. When they shout bubble at $80, it usually means $100 is coming. When they finally declare silver the future of money at $200, that is when caution matters. Right now, they are still in denial. Denial is bullish. This part is for you, the individual investor. You held through the bear market. You endured the sideways grind. Now you are winning, and winning is harder than losing. You will see account values you never expected. You will start calculating what you could buy if you sold. A car, a house payment, financial relief. The urge to sell will feel overwhelming. But you must ask yourself one question. What are you selling into? Dollars. The same dollars being printed to stabilize failing markets. The same dollars losing purchasing power by the day. Selling silver at $80 means exchanging scarcity for infinity, stepping off the lifeboat and back onto the sinking ship. Unless you have an urgent, life-changing need for that cash, patience is the correct strategy. This is a supercycle. These moves unfold over years, not weeks. The move from $20 to $50 was preparation. $50 to $100 is the opening act. The real event comes later. Do not give up your ticket before the show begins. So here is the verdict on this historic weekend. The system broke on Friday. Paper shorts were forced out. The physical shortage was exposed. We have entered a true price discovery phase that will rewrite market history. The banks no longer control price. It is now set by desperate industrial buyers and sovereign hoarders. 79.25 is not a peak, it is the breakout. It is the moment the beach ball finally cleared the surface. Your strategy for the coming week is simple. Watch the Sunday open. Expect gaps. Expect halts. Accept that $10 swings are now normal. Protect your holdings. Prioritize security. You're witnessing one of the greatest wealth transfers of our lifetime. From paper to metal, from debt to hard assets, from west to east, and you're positioned at the center of it, holding the one asset that still matters. Enjoy the weekend. Rest while you can. Because when Monday arrives, the world will not look the same.